Hello, everyone, and welcome to the first episode of Salion on BitcoinTreasuries.net, talking about everything Bitcoin and Bitcoin treasuries. My name is Alec Beckman with Tim Enneking, the managing partner and founding partner of Psalion, someone that I have the pleasure of working with every single day. Tim, how are you?
I'm doing well. I'm not sure that's always a pleasure every day, but I'll take it for what it's worth.
No, it definitely is. Tim, this is really exciting. We have the opportunity to speak directly to the BitcoinTreasuries.net audience, talk about Bitcoin, talk about what we're seeing out there, having a lot of communication with the Bitcoin treasury companies, having a different perspective than I think what most Bitcoin treasury companies and those involved have. So, Tim, I think a great place to start is, why don't you tell everyone about your background and how you got into the crypto space, Bitcoin space? And
I'll get there, but I think the important thing is, since this is the inaugural one, to talk a little bit more about Salion, as we say in English, Salion, but it's pronounced Psalion. And when we were setting up, I found two partners, my current two partners, and I invited them because I had this idea and I needed the people to do it, and they were the people, and it's worked really well. We're trying to find a name, and since I've realized, I've read some interesting articles on trying to find domain names, and the main domain names in mainstream modern languages are taken. So what do you do, right? And sometimes you can buy them, and sometimes you get lucky, but short names are just unobtainable at this point in time. So people look in two different directions. One is to finish, because it's not an Indo-European country. They have lots of short words, but they aren't taken because they don't mean anything in modern Indo-European languages. And the other is ancient Greek. So Loan, L-O-A-N, spelled like loan, but pronounced Loan. Both my partners are French. Loan came up with Psalion, which you would say Psalion in French. Salon is ancient Greek for chain. And with blockchain and everything else, like, okay, that's good enough. We'll go with Psalion. So don't kill yourself trying to say Psalion. It's like psychologist, right? You just let the P go. So with that little linguistic exercise in how we got named, my background was very much TradFi, except as far as I know, I was the first, let's say, serious fiat investor into crypto, because I was running an investment fund in Eastern Europe, a company that had started the first, as far as anybody knows, it's the first investment fund in crypto, called it cleverly the Bitcoin Fund, because Bitcoin was the only, what we now call, cryptocurrency around. And it was quite simple. People subscribed to the fund bought Bitcoin, people redeemed once a month, monthly liquidity. The fund sold. The guys that had set it up had no fund management experience, and we got to know each other because I was speaking. They liked the way I spoke, and they invited me to do some stuff for them. And they said, "Oh, wow, you've also got fundraising experience or fund management experience. Would you run this fund?" And I said, "What's the fund?" "The Bitcoin Fund." And I said, "What the hell is Bitcoin?" "It's the dumbest thing I've ever heard about." But since there's no discretionary management, it's just fund management skills, generic fund management skills, I'm happy to run the thing. And so I did for a while. I happened to be shutting down an Eastern European focused fund. This is about the time Putin, it was after Putin had invaded Georgia, but well before Ukraine. And I said to myself, this is not a place I want to be involved in. This is not an investment in direction that I want to take any sort of investment company. So I started shutting down that fund, pointing at, focused on Eastern Europe. And then as I started managing the Bitcoin fund, I thought, I had spent months and months and months looking at this, reading books on the tulip crisis or the tulip mania in the late 16th and early 17th centuries, lasted like 5 years. Read a book about Charles Ponzi on the streets of New York. I mean, really dug into it. People were laughing at me because of all the due diligence I was doing on Bitcoin. I thought, okay, let me put a little bit of my fund that I'm shutting down while I'm shutting it down, because it was a fund of funds, into this Bitcoin fund. Well, in the end, I decided not to shut down the fund, but I created a crypto or a Bitcoin trading fund. And as far as I know, created the first uh, crypto trading fund in history when I did that. But the other corollary was that's when Bitcoin went from like 50 cents to $100. And as a result of that, that fund of funds, I think it still has these records, not 100% certain. But for a while, it had the record for both the best annual performance in history of any fund of funds, not just for a given short period, and the record monthly performance for a fund of funds in the history of all funds of funds because of this little slice I put into the Bitcoin fund. So, okay, that was enough for me to convince me, all right, let me create a trading fund. I was living in Eastern Europe at the time. I moved back to the US, shut down that fund because it was an offshore fund. It's a bit difficult to run an offshore fund from the US, and created a US fund, which is now almost 9 years old, which is mind boggling to me. It's not the oldest, but it's one of the oldest crypto hedge funds in the United States. And at this point in time, it may still be one of the oldest ones in the world, even though the first fund I started 4 years before that. So that's the crypto side. On the TradFi side, I'm not going to go into all of the qualifications I have, but let's put it this way: I've got 5 degrees, speak 4 languages, and I'm still undereducated. But until last summer, or 2 summers ago now, I was the CIO, the chief investment officer of an almost 10-digit family office. For 9 years, I ran this thing. And during those 9 years, I tripled the value of the family office. And the family office did no crypto whatsoever. I was hired purely because of my fiat or classic finance, whatever you want to call it, qualifications. So, as I often say to people, there are guys that know more about crypto than I do. Not a huge number of them, and not a huge amount more, because I've been doing it for now 13 years. And there are a lot of guys that know more about fiat or classic finance than I do. But there are very, very few people that know more about both combined than I do. And to the extent I have any qualifications to have an opinion, that's probably the biggest one.
Perfect. And Tim, just curious, when you were the CIO of the family office, did you ever push for investment into Bitcoin?
I never pushed for it. I raised the crypto concept a couple of times, especially when Coinbase went public. And the two trustees, older gentlemen, they were both, how can I put this, rabidly against it.
Mm-hmm.
And just did not want to have anything whatsoever to do with crypto. They've gotten a little warmer, as I understand it. I don't work with them anymore. I stopped in July, I think, of 2024. I don't think they're quite as anti-crypto now, but I don't think they would put any of the family office's assets, the biggest part of the family office in this case happens to be a trust. I don't think they would put the trust's assets into crypto either. But it's going a little bit more mainstream, so many people are warming up slowly to it. But now that we had this drop in the last, the high was in October, so 4 months now, a lot of people who are warming up to it, including some long-term crypto guys, are a little bit cold on crypto these days.
Yeah, it's the meme where you have everyone lined up when the price is at 120K, and then the line is empty when the price is lower again. Around 70K.
And let me tell you a story about that. My fund, the fund that I run, it's called Crypto Asset Fund. I'm not trying to sell it, just so I give it a name. CAF, we call it. It's very easy. CAF, the one what I founded in 2017. In 2021, it was the best performing hedge fund in the world. Not the best performing crypto hedge fund, but the best performing hedge fund in the world. And that was nice. It was honestly a couple of smaller tokens that just went nuts. But then in 2023, it was the third or fourth best performing crypto fund in the world. I know it was high because it was nominated for a couple of prizes, and there were 3 or 4 other other hedge funds that were nominated as well. So I knew we didn't win. So I knew and I don't think we were second. So third or fourth. So did fairly well. In 2023, though, this is based on what you just said, we did no trading. But on November 15th, 2022, which of those who are familiar with crypto, when that was the day or the day after, depending what time zone you're in, FTX declared bankruptcy. We took all the fiat assets, the stable coin assets in that fund and moved them into BTC, ETH, and Salon. And that's it. We never traded in all of 2023. I just didn't feel the need to. And we rode that recovery. I called it the artificial FTX capitulation. Because when you want to get in is when that line you were talking about's got nobody in it. Then you walk up with all the bags of money you have. When the fear index is through the roof, that's when you buy. And when the greed index is breaking new records, get the hell out. You'll never hit the exact bottom and the exact top, but that sort of contrarian philosophy, particularly in crypto, where it's not yet the most sophisticated of markets, that's a really, really good way to invest.
Mm-hmm. Actually, yeah, the chart, interestingly enough, just to back up exactly what you said, if you would invest at all-time lows and trade out at all-time highs of fear greed, you would be doing very, very well. And then I think 2 days ago, we actually hit an all-time low on the fear inside of the index. So it is.
I read the same thing. Yes, time to go in. But you can even take it further with some very interesting statistics, because really about correlation. People talk about how BTC for a while, especially in 2024, was in part of 2025, was really correlated to fiat markets. You look at the statistics and yeah, it seemed to be correlated, but there's one problem. For two markets to be correlated, they both have to be open. They both have to be working. Sounds sort of obvious to say, but when you think about it, I published an article on CoinDesk about this one time. If you analyze the number of hours that fiat equities markets are open, the longest one happens to be the FTSE, or the LSE, the London Stock Exchange, is open 8.5 hours. And, in the U.S., markets are open from, 9 to 4:30, so they're open 7.5 hours. You add it all up, and crypto markets are open roughly 5.5 times longer, because they're 24/7, obviously, than fiat markets. So if you're going to correlate those two markets, you're literally drawing massive conclusions from the 20% of the time when fiat markets and crypto markets are open. And I read a fascinating study. I don't remember who did it now, but somebody calculated, all right, if I had Bitcoin and I sold it when the New York Stock Exchange opened. I bought it when the New York Stock Exchange opened and sold it when it closed every day. I think it was in 2024. He calculated you would have lost about 20% of the value of your BTC. If on the other, or 20% of the BTC, not the value, the number of your BTC. So it would have been a significant loss. However, if you did the contrary, you bought BTC at the close and sold it the next morning, or if it's on a Monday morning, sold it when the market opened, you would have increased the number of Bitcoin you own by 200%. And I found that just fascinating, because it really underlies the fallacy of correlation, because often people are correlating markets, obviously crypto with something, given our topic here. You're correlating something that never shuts down, including massive holidays around the world, because the holidays rotate around as well, and other markets that are open 20% of a given week. And if you take out holidays and other things, it turns out to be less than that. It really doesn't make a lot of sense to draw too many conclusions from those correlations when it's something that's open 1/5 of the time. Yet people do it, and that in and of itself makes it relevant. And if everyone thinks it's relevant, even though logically it should be, hey, it's relevant, right? It becomes a self-fulfilling prophecy. But it still is fascinating that the people don't pay attention to the differing opening and closing hours. Crypto obviously has none. and yet they still draw important conclusions from correlations.
Mm-hmm. I think that if anybody had any questions about whether you're qualified or not to talk about Bitcoin, I think that was the perfect preview to show why you are. And we're gonna cover a number of topics today, which I'm really excited about. And then after the discussion that I have with you, you and I actually pre-recorded an interview with the vice president of Bitcoin strategy, Joe Burnett at Strive, which recently acquired Semler Scientific. So we're going to cover a number of things today. But before we get into a lot of the topics, Tim, why don't we talk about what the relationship is now that people know what Salion is? Obviously, people who are watching this are familiar with BitcoinTreasuries.net. Let's just talk a little bit about what the relationship is there and what the goal of this of these episodes, whether you call it a webinar or a podcast, what we're trying to do, who the audience is, and really what the connection is between the two firms.
Sure, of course. It's very straightforward. Salon has two businesses. There's a VC business, which doesn't really play into this, so I'll put that aside. The other business that has is a yield business that at its peak at about $250 million under management. We're still around 200 million for reasons I'll get into. But what we do is generate yield on mainly BTC, ETH, Solana on the token side, and stable coins denominated in dollars. And to some degree, they still aren't very popular, but denominated in euros. And so where Salion business meets DATS, meets digital asset treasury companies, is in the yield. Now, there are some people like Saylor used to be at Strategy, who are strictly my keys, my coins. We're going to put them in a cold wallet, lock them up, maybe make a copy, and never touch them. And I respect that, and there's certainly a rationale to have that attitude, perhaps not with all of your assets, but with a significant portion. And then there's another school of thought that is, okay, let's generate some yield on these assets, because some cases people have literally billions of dollars of assets and they're actually paying for storage, or if it's an ETF or way back when in GBTC, they're paying what I call a tax for somebody else to hold on to those tokens. And in reality, they could be generating a yield. And that is what Salion does. It generates yield through allocations to liquidity pools in DeFi protocols, the centralized finance protocols. And before people go crazy, oh my God, that's so risky, etc., let me just say real quickly, we have been doing this for 5 years. We have done about, not really sure the exact number, it's around $14 billion of total allocations. And because we do it as SMAs or segregated managed accounts, it's a lot of individual allocations. We've done over 500,000 allocations to liquidity pools denominated in the various assets that I just mentioned. And we have never had a non-positive result. I never had impermanent loss, anything else. And we'll probably end up explaining in a different episode, or maybe even very briefly in this one, how we do that in general terms. But that is what our business is. So it interconnects perfectly with Bitcoin and potentially other, but Bitcoin is the real focus here, treasury companies, because instead of having the cost to run the company and sitting on all these assets and having absolutely no return from that and living only on appreciation, which is really theoretical because they never, thus far, no Bitcoin digital asset treasury company has sold their Bitcoin, or none of the main ones have in any event. That it really makes sense to try to cover those real expenses by something other than a theoretical increase in valuation. And yes, they issue shares of stock, so they concretize, if you will, that increase in value, or issue bonds or whatever. Their assets, though, are completely dormant, doing absolutely nothing. And that's where there's an intersection between what we do and what they do.
Mm-hmm. And for these Bitcoin treasury companies, you see a lot of them throw out the term price per share, or the phrase price per share. of Bitcoin, and this is a real way to differentiate with all the competition in the digital asset treasury space as the space gets more crowded. And we'll talk about this a little later, but a lot of these publicly traded companies are now trading at discounts to NAV, and so giving an opportunity to be differentiated as well as generate additional yield on that Bitcoin can obviously be extremely positive. In terms of
So let me jump in with one thing there. I think it's positive in all the ways you're describing, but it's also positive in another way, and that is the strategy that we use is completely market neutral. So at times like now, where the assets Bitcoin from top to bottom lost just over 50% of its value, Bitcoin we're not generating a lot of yield on now, but it's still about 3.5%. So it doesn't compensate, it doesn't offset this huge loss. But if you're with the next guy and you've done this for 2 years and the that next to you hasn't done it, and you made 7% over 2 years with us and the other company has it, if you think about it, they're going to go down 50%. You're going to go down in the low 40s. For you to go up, they need to fully double to get back where they were. You only need still a lot, right? But you only need to go up 80% versus 100%. It has an outsize effect. Any small decrease in the loss has an outsize effect. We can use some round numbers to illustrate the point. Let's say somebody goes down 40% and somebody else goes down 30%. You're going to say, okay, well, 10% outperformance. But then both of those go up 50%. The one that's went down 40, that went up 50 is now, they were at 60, they're now at 90. They still haven't made they made it back. The one that's gone down 30, they're at 70, they go up 50%, they're 105. So there's a 15 percentage point difference there, even though it was only 10 on the way down. That's why there's a real multiplier effect in bear markets if you can generate a little bit of yield any which way you can.
And speaking of bear markets, that is a great segue into where we are now.
Unfortunately, yeah.
Specifically with the price. And it's okay. You say unfortunately, it's always better when the price is up, obviously. But I think Bitcoiners and people in the crypto space are used to the volatility by now. And a lot of people aren't shaken by this drop off, which I want to ask your opinion about this. I just saw Bitwise's CIO, Matt Hogan, declare this a full bore crypto winter. So I wanted to ask, do you agree with that? What are your thoughts? Where are we? Obviously, not financial advice, but as someone who's so seasoned in the space, both trading and holding and acquiring, where are we today, and where do you think we're headed in 2026?
Let's start with the first one, volatility. And you're going to say, oh my God, the volatility of crypto is insane again, right? It's crazy when it started, but essentially, especially if you look at 16, the crazy market in 17, the crash in 18, this 4-year cycle. But if you look at the last 4 or 5 years, the volatility has been very, very steadily decreasing. And then you may conclude, the last 4 months, volatility's through the roof. Crypto's lost all of the progress it's made. And I would really, really strongly disagree with that, because measuring volatility in isolation really isn't fair. So if you look at this one asset, hey, the price is going up and down a lot. That's super volatile. Why is it? If the price of many assets is going up and down basically at the same time in the same way, ignore the correlation aspect of that. But hey, markets are just volatile because of macroeconomic instability. That doesn't mean that asset in and of itself is volatile, or certainly not any more volatile than anything else, because everything is moving up and down. So let's take crypto compared to fiat volatility, especially precious metals. And yes, I'm cherry picking something that had a lot of volatility. But with everyone talking about Bitcoin being the digital gold, I think it's an appropriate thing to select. Silver, which had set new records, mucking around at the $100 level, it went down 20% 2 Fridays ago. 20%. Bitcoin has yet to do that in a single day in the last probably 3 or 4 years. So if you're going to reach a conclusion about volatility, you have to reach that conclusion in the context of other assets. So if you did a relative volatility calculation of Bitcoin to precious metals, Bitcoin was exponentially higher 5 years ago. No doubt about it. And it's still been higher until probably a year ago, but it's been going steadily down relative to the volatility of precious metals, in particular gold and silver. And then you hit 2024 election in the US, and crypto goes crazy in general. And we've now given all of that back. But one of the reasons we've given it back is because Trump's approach to virtually everything is chaotic, and it is undermined many institutions ranging from the OECD to NATO, to the strength of the US dollar, to the reliability of the United States as a trading partner, really shaken some fundamental pillars of what people viewed as sort of the social democrat, the social democrat stability that we've experienced, culminating with Fukuyama's book, The End of History, right, where social democratic capitalism is really the end state, and we're just going to work on making that better. All of that has really been turned on its head in the last 14 months. And as a result of that, you have gold that really had never been significantly above 2,000 is now suddenly above 5,000. That has nothing to do with crypto. It's crazy volatility because people view gold as a hedge, and they have for literally tens of thousands of years. Not 10,000 years ago viewed as hedge, but viewed it as something of value. And because of that crazy volatility now in gold and silver, to say, hey, Bitcoin is bad to its bad old days is really unfair, because the relative volatility of Bitcoin to gold, and especially the silver, strangely enough, has not gone up over the last 4 months. And there are periods where the relative volatility has gone down. So when you're looking at an investment and looking at whether an investment is correlated, because you want to diversify your investments, but correlated diversification is fake diversification. You're just confusing yourself, convincing yourself that your portfolio is safe when it's not. You want non-correlated diversification. And it's really important now to look at volatility relative to other asset classes. And if you look at Bitcoin and crypto in general relative to a lot of asset classes in the world today, the volatility may be less, but it's certainly not hugely greater as it was 3-4 years ago. Long answer to the first part, but I think it's very, very important to understand that volatility is not something that can be measured in isolation.
I know you wanted to speak about the 4-year cycle.
That's the second point. Yes.
Yeah.
To me, the 4-year cycle is dead, except for one thing. There are a lot of people who think it's not dead, so they sort of cause the 4-year cycle to continue, to linger on. But let's face it, the 4-year cycle was driven by miners, because the miner reward was cut in half every 4 years, roughly 4 years. Right now, miners don't have a significant effect because 97% of all Bitcoin has been mined. The halving of the reward, or the halvening, as some people like to say, is just not anywhere nearly as relevant as it used to be. And so you can see the first 4-year cycles, right? So you have the big bull. People are looking at 25, so 21, 17, and 13. Those were clear 4-year cycles, not happening when the halving happened, but within 3 to 8 months, depending on which one you're looking at. There is some variability there. And so you look at this last one, the last cycle, 25 should have gone through the roof. Well, it didn't, because 24, you had that sort of teasing of the next bull market, because you had 11 spot BTC ETFs approved, and then you had the halving in early 2024, and everybody's going, oh, man, it's going to go up now. So in March and April, Bitcoin shot up and then went down. We had the doldrums for another 6 months. because that really was the 4-year cycle. They didn't kick in right away, mainly because miners had inventory and they could hold off the effects of the halving for a while. And then so it starts to go up at the end of 25 or the end of 24 and early 25, and then it falls back again. So the behavior in this past 4-year cycle was already radically different from the behavior of any prior 4-year cycle. And now crypto guys are thinking, okay, another crypto winter, another crypto winter. It's a down market, it's a bear market, but it's not going to be the 12 to 18 month crypto winter that everyone is talking about. We're looking at, say, maybe this summer, simply because the market has changed. There's this principle I call, very tongue-in-cheek, mind you, Enneking's law, a play off of Moore's law. And the Enneking's law is that the profile of the average crypto investor changes every 18 months. And if that happens, the market behavior changes. So what have you seen in the last couple of 18-month cycles? You've seen that digital asset trading companies go in. You've seen companies go in. You've seen a lot of fiat major financial institutions, if not go into crypto, at least provide access to it to their clients. So you really have seen the profile of the average investor change significantly. And as a result of that, you've got both the financial or the economic reason for the 4-year cycle that's falling off, and you have the kind of investor that looks at crypto to whom a 4-year cycle is not, the prior 4-year cycle is not nearly as important. So the 4-year cycle is dead. It's dying out now, and the next one will probably not really even be perceptible except to people who really want to force a square peg in a round hole and say, oh yeah, that's the new 4-year cycle. It's dead. It's gone. We're not going to have it anymore, and that's a good thing. You don't. The 4-year cycle was a bit ridiculous in some ways, and so it's effectively over.
Yeah, actually, it's really interesting because we've seen a decent amount of crypto hedge funds recently fold, and they're underperforming, and it's a lot harder. And so it begs the question: were a lot of these guys lucky rather than good? Could they read the cycle, but as it breaks and becomes less predictable, let's call it?
It's a really good point. When you know the tide is rising and it's going to lift all boats, you jump into any boat and you're good. Mm-hmm. But using another fiat example, right now we're in a token pickers market. Just like you're in a stock pickers market, you've got to pick the stock based on the underlying or the quality of the underlying company. If you're picking tokens and you're not just picking the mainstream blue chip ones, you're going way down into the hundreds or the thousands in terms of market cap ranking. Mm-hmm. You can make some really good investments even today there, but you have to analyze the underlying company. So unless you're doing a meme stock, and I still never invested in Doge, and it won't go there, and I don't do meme stocks, and most people I know at one point in time made lots of money, but they lost all of it eventually. I don't touch the things. I look at fundamentals. So at one point in time, it was really oxymoronic to say I'm a fundamental crypto investor. There were no fundamentals. Now it's all about fundamentals. And on the VC side, I guess it's tangentially related to this. In 2022, we launched our second vintage. We set a target of 2/3 equity, 1/3 token, ended up doing 85% equity. It's fully invested now, so it's done. But the fund is doing really, really well. And other, not just hedge funds that you were talking about, but VC funds, they've gone under. The token ones, many of them have. They've done in-kind distributions of their tokens because we never had the alt season. They haven't made any money. And as we've launched, we're closing the launch of our third vintage, and we're raising money really, really well with that because of this strategy. And as we look back, we realize we were one of, not the only one, but one of the very first blockchain crypto hedge funds to eschew tokens and focus on equity. And as a result of that, we survived and other people didn't. But there are very few people that have adopted that thesis. And that's one of the reasons why in this bear market, we started fundraising in September, right? So Bitcoin hits a high in October. Money's easy then. But since then, that's when we've done most of our fundraise for the third vintage. And we've hit our goal, even though there are, massive macroeconomic headwinds in the crypto space, mainly because we focus on equity, not tokens.
Absolutely. So just to piggyback off of your 4-year cycle commentary, you see the difference of where we were in, let's call them prior cycles, to where we are now, where to your point, we've probably broken out of the 4-year cycle, or it's dead. And how does that compare in terms of retail versus institutional buyers?
Deliciously ironic, I think, is a good phrase for it, is that finally it is probably not easy, but it's getting easy. And in some cases, it's quite easy for retail investors to buy crypto, and they don't want to. I just find that just so ironic. The fact of the matter is, though, retail investors are more, I don't mean to insult retail investors. I was one for decades, but retail investors are less sophisticated in general, and they are more subject to the bandwagon effect, right? Hey, everybody's buying it, let's buy it. Everyone's getting out, let me get out too. So they're more following along with the crowd. And as I mentioned earlier, if you really, really want to do well, you buy at the bottom when everybody is selling. Everybody thinks it's hopeless. Capitulation, right? And usually the capitulation takes a while, and it's difficult to figure out when really is capitulation. And in my opinion, we're very close to it now. All sorts of indications of that. And almost nobody, Bernstein came out with a $150,000 target for Bitcoin at the end of the year. It's literally the only positive comment I've seen. Everybody else saying, oh, we're going to see 50, the bottom's 50, maybe the bottom's 45. When all you're seeing are negative articles, it's time to buy. When we were at the top, everybody's saying, oh, it's going to 150, it's going to 200, it's going like, when everybody is saying, my God, it's going higher, get out, get the hell out. That is the time. And retail buyers find that much more difficult to do, to buck trends, if you will. Institutions, first of all, have a lot more money, right? Secondly, they're diversified. This isn't their whole fortune that they're putting into crypto, and retail investors shouldn't put their whole fortune into anything, right? As I tell everybody, the 3 principles of investing are diversification, diversification, and diversification. So don't do that. But if you're what you have in any asset, except if it's a really, really unusual situation, be patient. And financial institutions can have a longer time frame for investing. They can look over a longer history, and they can put any short-term moves into long-term context. And in theory, retail investors can do that too. But, when you're sitting there alone and, on your computer trying to figure out whether to buy or sell, and people should DCA in and DCA out, right? So dollar cost average in, dollar cost average out. The average retail investor reaches a binary investment decision. Oh, I'm going all in today, right? Because they happen to have some money. There's a lot about the average retail investor the average retail investor's behavior that is suboptimal for investing in general, but it's really suboptimal for investing in something that's relatively volatile, like crypto, especially when you get past BTC and ETH and some of the blue chips in the crypto space. Crypto will come back. There'll be another cycle. This is a bear market, very obviously. I don't think it's going to be that long. It's not going to be like the last 10 months of 18 and most of 19, like the last big bear market was, or even 21 was a bear market, but wasn't nearly as bad for the reasons we were talking about before. So the market will come back. The retail investors will come back. But the time to invest is literally, this is not formal investment advice. Don't get me wrong. This is how I approach things. The time to buy is now, when everybody else is screaming. And there's the lovely, the fourth Baron de Rothschild, who talked about, you have to invest when quand le sang coule dans les rues, when there's blood running in the streets. And he didn't mean revolution. What he just meant is buy when everybody else is running away, when it's a bloodbath and securities, equities, metals, whatever you're talking about, currencies are getting hammered, go in.
Yeah, I saw an incredible buy signal today. This writer at Bloomberg in the APAC region sent me an article this morning saying Korea's retail market has quit crypto, and my immediate thought was that is as good of a buy signal as any.
That's an interesting one because South Korea, has the highest percentage of crypto ownership among its population of any major country in the world.
Tim, another question that I often get from more retail types that I'm hoping you can shed some light on. A lot of people see these headlines as the price is stagnant, as the price is going down. A lot of people will see these headlines of people like Michael Saylor, of these big institutions, of the BlackRock ETFs having a ton of inflows into the market. You see these headlines, Michael Saylor just bought, X amount of Bitcoin. But people don't understand why that doesn't correlate with price activity. Do you have any thoughts there, or just some shedding of light of how these markets actually work when something like that happens?
One of the things I mentioned earlier was that crypto is not the most sophisticated of markets. And it's still not, but it's getting progressively more sophisticated. At one point in time, you could go to CoinMarketCap or CoinGecko or whatever your source is for prices, and you would see what the prices are doing. And that would be virtually all the trading that was taking place in that token, whatever it happened to be. Then you have DeFi, right? Decentralized finance. And so you've got Uniswap, the original one, and SushiSwap, and some of the others come on. I can say Sushi Swap, I really can. And they start taking market share away from the sexes, the centralized exchanges. And for a long time, DEXs, these decentralized exchanges, were not included in CMC and CoinGecko. Well, now obviously they are, but it took a good long while. But then you have the market that was always there, but relatively small, where it OTC, right, over the counter, which just means one guy sells to another guy, and you have a lot of OTC desks spring up when the margins are like 4% of the value. Do $1 billion deal and make $40 million. Those days are long gone, but OTC deals don't hit exchanges, centralized or any exchange either. And then the last tendency you have is you have a lot of derivatives markets where you're not actually trading the underlying, you're betting on the price in a more sophisticated way. If you're short, you're borrowing, but you have options versus futures, and you don't always have any effect directly on the supply of the underlying. So what's happened is that the market is really fragmented, and somebody like Strategy, they can buy a lot of Bitcoin. They don't have to go to a centralized exchange and say, okay, here's my order. I want to buy 10,000 Bitcoin at spot, right? No one would do that anyway. But to make my point, that would immediately drive the price up. It would hurt them because they end up spending a lot more. So when Saylor buys, he buys OTC. Actually, he buys mostly OTC on several OTC markets, but those markets don't have any effect on the price, on the spot price, because they're not there. And then other things like derivatives markets, they have more of an effect. So the spot trading doesn't even have as much effect on the spot price as it used to. So, we love, and certainly the buying that Strategy and other large DATs are doing, it supports the price because the 10,000 BTC that Saylor bought or Strategy bought it on a given, or announced on a given day, that he bought over, say, 30 days OTC, that does mean that supply, somebody wanted to sell it, obviously, didn't trickle out into the wild. So it was clearly supporting the price, either moving it up slightly, perhaps moving it up a lot, or preventing it from going down even further. So, okay, it has an effect. but it doesn't have this dramatic immediate effect that it would have had in less sophisticated markets 5 years ago. Keep in mind, DATs have bought more Bitcoin than has been mined, I'm sure, to date in 2026, although I haven't seen the statistics on that. But in 2024 and 2025, they bought up more than was mined. So even though the price was actually going up and down during that period of time, it would have gone up less and down more if those DATs weren't buying all of those Bitcoin, because the miners were going to sell them anyway. So that's why you don't see a massive impact on the spot price, because big buyers aren't buying on a spot exchange.
Mm-hmm. Well said. Okay, Tim, this was brilliant. I think this was an amazing way to kick off the first episode of Salion on BitcoinTreasuries.net.